The 7th edition of the Aditya Birla Sun Life Mutual Fund presents Voyage 2020 Navigating to a Better Tomorrow, partnered by ET Now, was held on the digital medium. Thought leaders from across sectors and geographies came together to share the best insights and inputs for the mutual fund industry on this year's theme of Navigating to a Better Tomorrow. Day 1 began with an opening address by Aditya Birla Sun Life AMC's MD and CEO A. Bala Subramanian.
These are unprecedented times. The world is battling an invisible yet potent enemy, the coronavirus. Governments, central banks, businesses all around the globe are in uncharted waters, taking calculated measures and decisions in the face of uncertainty that the COVID-19 pandemic has unleashed, hoping to sail through the rough seas of business disruptions, fragile economies, feeble business, and economic outlook. The macro and micro drivers of businesses and economies are facing headwinds, with the life of people coming to a stagnation. It is in these times that guidance of the policymakers and thought leaders is indeed needed the most. We at Aditya Birla Mutual Fund aim to humbly provide, through our flagship annual event, Investment Voyage Conclave, some guidance and future direction by inviting experts to decode the current situation and make best possible decisions in the world of investment. The mutual fund asset base has had a phenomenal growth and has reached a total size of 24 lakh crore. Average assets under management as on March 2020. The industry has attained scale over the last few years due to increased financial awareness and a higher digital penetration. Post this IL&FS crisis in the year 2018, financial market went through its own challenges in the form of multiple credit events related to India and general slowdown that we have witnessed in the overall economy. In the equity market too, handful of stocks were driving the Nifty and Sensex movement, leaving behind scores of mid-cap and small-cap companies that delivered significantly below average return to shareholders during the last 2 years. In the face of all these ups and downs, the Indian mutual fund industry continued to focus on growing the retail and SIP book. The retail asset base of the industry has crossed rupees 12 lakh crore as on March 2020. The monthly SIP book for the industry stands at 8,641 crores, with almost about 3.1 crore live SIPs as on March 2020. The total outstanding AUM and the SIP is close to about 2,47 crores as on March 2020. The total folio account for the industry is close to about 9 crore folios outstanding as of March 2020 for the whole industry. Our strategy around 3 Ps, namely people, performance, and process, with 3 Cs, clarity, commitment, and consistency, with a motto of making it win-win for everybody, for our investors, distributors, and assets. While we remain committed to this process, no doubt in the last 2 years or so, we had to face many challenges and further got added up post-COVID-19 issues as well. I'm confident we will come back on our strength and strong belief on 3 Cs and 3 Ps in the coming year, as the past learning from our own mistakes makes us to do even better in the coming years. Our process around risk management and compliance has improved our governance standards quite substantially in the best interest of all stakeholders. The strategy of continuous engagement with our valued investors and partners has improved our mindshare. And one of the engagement we take pride is around creating awareness about investing in mutual fund by our dedicated team across the country throughout the year. As the world is moving towards the digital direction, we too have evolved and have launched an exclusive mobile app for our distributors, ABSLMF partner app and partner portal, which acts as a one-stop solution to our distributor needs. In the same way, we have also created mobile apps, ABSLMF Fingo app and ABSLMF Active Account app for investing in liquid fund for our investors to provide a greater convenience in dealing with our fund house. Through a single click of a button, a partner or distributors can email all his or her customers to top up the SIP of their customers and explain about the new product or new features, among other things, which are now been built as part of our website itself. I feel that the year ahead is going to be filled with lots of unknown variables that can impact the sentiment towards the investing world, the financial service industries, and mutual funds in general. We are in the uncharted and untested waters today, and with the future looking uncertain, it is important to remain hopeful and positive. And no doubt there will be a period of ambiguity and turmoil, but there will always be a light at the end of the tunnel. Recently, the RBI governor has promised to do whatever it takes and is necessary to support the economy through these challenging times. The government too has announced yesterday a major structural reforms by dedicating 10% of the GDP, amounting to 20 lakh crore to revive the Indian economy. Our Honorable Prime Minister aptly touched upon the 5 pillars of the economy, which is economy, infrastructure, systems, demography, and demand. In order to make these 5 pillars deliver the desired results, Prime Minister also has announced reforms that will help in removing the bottlenecks around liquidity, labor, law, and land. I'm confident that the RBI and the government will continue to come with various measures that will propel the growth of our country and eventually help India to emerge as a strong winner among the rest of the global economies. While markets will go through its motion and ups and downs, if one carries a long-term focus on wealth creation and concentrate on asset allocation without being influenced by either fear or the greed, there is meaningful gain to be made from mutual funds. It will continue to be one of the best vehicles to invest in the market, providing a comprehensive solution to investors' needs based on their financial goals and risk appetite. Asset allocation is a mantra of the hour and is always the mantra in the world of investments at any given point of time. The solutions offered by us under the 4 buckets of savings, income, wealth creation, and tax savings are designed to take care of asset allocation needs of customers. If each of these solutions are used in the right manner, as per one's goal, it will provide a better experience to investors through different market cycles.
Veteran market expert and co-founder of Enam Securities, Vallabh Bhansali was in conversation with ET Now's Nikunj Dalmia on market movements and learnings from it for the everyday investor.
If indeed this is a crisis, as a seasoned investor, where are you picking your spots in terms of funding opportunity? I want to remind and just take the clock back, Mr. Bhansali. As a firm, as an individual, when Infosys went public, the IPO did not do well, but as a house, you backed it because you were able to convert that crisis into an opportunity. What is your view on converting crisis into opportunity?
I think clearly when liquidation happens in the markets, a lot of good names get beaten up. So let me also, give another perspective to the Infosys saga, and it is very important. What happened at the time of Infosys? It was very important to see the man behind the business. He was a unique person. I had done hundreds of IPOs by then, but Mr. Narayan Murthy and his team, they brought very different values to the market and to the world. And same thing applies now also. Whatever be the business, if you see a businessman like them being punished in whatever sector, go and to look into that. So what other thing one would look at is abiding businesses. That means what we call business with a long tail. So if you see an abiding business and a top class value leader, say someone like Deepak Parekh, Aditya Puri, and now our own Radhakishan Damani, they represent those kinds of promoters. And if their stocks are getting beaten up, that's the place to go to. And they do get beaten up when liquidation happens across the board. So I think look there.
Why markets are behaving in such a synchronistic manner?
We have come out of a long bull market, though we had a correction, massive correction in 2001, 2008. We still came back. As I said, the world was never on steroids of the kind that it is on today. In 2008, we were not on steroids. The Feds and all were not trying to support the market already when the market crashed. This time, there is a big situation, as I said, that the world powers clashing is one. We're dealing with the medical situation, which we do not know how it will play out. People thought it'll, go out in a V manner. Now it's a W manner and it's a long W manner. So we do not know. So the moment you see bad news, people panic. Moment they see, vaccine will happen, this will happen, big stimulus from America, UK, etc., people get excited. It is the hangover of the bull market that, brings them into that FOMO very quickly. I think people have to wake up and become very stable that we deal with a very terrible cocktail at this point of time. And while you must back equities, there's no just question about it, you must back good promoters because they are the most abiding entities in the world history. So you must back them, but you have to not get the FOMO will be a danger, definitely.
How do you think the wheels of the economy now will readjust, and where do you think the new opportunities in terms of entrepreneurship and in terms of profit pools will emerge?
I think some form of technology, telecom definitely dominate. And you're seeing that even in these terrible markets, the telecom stocks and technology stocks have held up well. I think their importance is only going to grow. As we work from home, as the need for communication grows. As you said, the Voyage is a different form now. And the reliability of this is going to grow many, many times. So many forms, from IoT to 5G to virtual reality to, this connected world, safety. You're going to see automated pharmaceutical health. You're going to see very soon automated, COVID testing labs come out, because, the frontline warriors cannot go on the way they're doing. So you're going to see, automated robots taking care of, patients and so on. So on the whole technology side, a huge amount of opportunity is going to come. The second is, a new social norm of, how the new entertainment will come. Today, the IPL cannot have 30,000 people in a stadium. So how is this going to change? So is betting going to come into it? Is virtual reality going to come into it? Is gaming going to come into it? So the way we amuse ourselves, the way we educate ourselves, the way we work, everything is changing. So therefore, all those who are at cutting edge in these businesses, so they establish, for example, the physical retail is changing big time to, online retail.
And clients, Mr. Bansali, are asking tough questions. And the simple question which they are asking is that in last 10 years, equities, which is Nifty, and gold has given a similar return. With Nifty, I took pain, I took volatility, and with gold, I took nothing. And if my returns in 10 years are same, is equity investing worth it?
So as I said, that you have to back the businessman. I think, while the index as such may have given the same return as gold, individual stocks have outperformed. And so this is going to be the challenge. As more and more people invest in stock, the alpha is going to become more and more difficult. I see alpha becoming even more difficult in a very uncertain world. As to, because gold in this period has given the same return as equities, and therefore gold is a better investment for all time to come, answer is clearly, the gold has had a run, the gold is under-owned, and therefore gold may have potential. So I would say definitely, something I haven't said in my career, that you should have definitely some amount of money in gold, because the times are so uncertain.
Welcome back to Aditya Birla Sun Life Mutual Fund presents Voyage 2020, Navigating to a Better Tomorrow, partnered by ET Now. Next up, we were joined by the President and CEO of Sun Life Financials Canada, Dean Connor.
Now, since Sun Life started, we've seen many changes over many years. We've been through the Spanish flu, the Great Depression, 2 world wars, the oil crisis, global financial crisis. Each crisis was different, but Sun Life learned a number of things that have helped us come out stronger on the other side. And I'll share 3 of those with you. And I think these 3 things are as true for you as financial advisors and true for you and your businesses as they are for Sun Life. The first one, never waste a crisis. In the global financial crisis, we used that opportunity to launch 3 new businesses that generate over $200 million of net income. In this crisis, we see the opportunity to accelerate the digital investments we've been making to put more daylight between ourselves and our competitors. The second big learning is that communication is critical. And by that, I don't just mean talking frequently with your clients, but it's how you do it. So being realistic, not glossing over the challenging parts, but confident. Being humble. So we don't know how long or deep this recession is going to be, but positive. And the third big learning is that your purpose is your North Star. So for us, our purpose is to help our clients achieve lifetime financial security and live healthier lives. And so everything we do during the crisis, around the crisis, is reinforcing that purpose as a company.
A lot of questions are coming from various participants. One of the questions which has come is, I think the last 1 month, rather 2 months, the equity markets have been extremely volatile, and it has taken away the returns for investors which would have generated over a period of 3 and 5 year period. Everything got taken away in a 1 month period. And during this period, when investors' confidence got shaken up, on these occasions, the question which is coming is, how should one go about one advising investors as well as even advisors themselves have to stay confident. How do we manage these situations to give the confidence to themselves as well as to the investors?
Yeah, I think first of all, acknowledging that concern of investors, that acknowledging the fact that the markets have gone down, the markets have been extremely volatile, and just acknowledging that you understand why people would be concerned about that. Personally, I like the escalator analogy and the yo-yo, the escalator and the yo-yo. I think it's a way for people to understand the longer term picture, the need to look over the longer term. But the yo-yo on the escalator is not enough. You need to complement that with data and go back and look at and be able to talk about some of the big market volatile moments, 1987 crash, the global financial crisis, to be able to spotlight the importance of systematic investing through those periods, and also spotlight the folly of selling out and cashing out at the wrong moment at the bottom. And to me, this is where advisors really add value, which is persuading clients to not sell right at the bottom. The other thing is to remind people that after this crisis, the world will go back, and people will need to buy cars, they'll need to buy bikes, the economies will be transformed. The Indian economy will continue to transform. It's unstoppable. I mean, the movement of people into the middle class, the development of India, and all the dreams around economic expansion in India there'll be stops and starts along the way, but the direction of travel is unmistakable. And I think investing in that for the longer run makes a lot of sense.
Some of India's best and biggest mutual fund distributors logged into Voyage 2020 to share their thoughts on selecting the best fund house and the science of scheme selection.
The new normal, Karan, is risk and volatility are back and they are here to stay. So how do you define the whole matrix for us now, Karan?
I think asset allocation is undoubtedly the main key for any client's portfolio. I think the determination of return, nearly 80 to 85% comes out of asset allocation. 15 to 20% would come out of instrument selection, and potentially 5 to 7% out of timing. For asset allocation, I think the biggest metric we look at effectively becomes price to book and price to earnings. Very simplistically put, obviously the world's not as simple as what I'm going to say, but very simplistically, a P band of 17 to 20 on forward earnings and a price to book, in a commensurate range are more or less where the markets end up trading 75 to 80% of the time.
In this time, when everything is helter-skelter, there is no new normal, definition of investment has really changed. What is your deep dive in fund selection indicating?
A lot of our customers are first-time investors to mutual funds. So our desire is not to make them the highest return. Our desire is to make them the highest return on a risk-adjusted basis. So these were erstwhile FD investors who were trying to come to mutual funds for the first time, trying to get a return higher than inflation. So we always try and first do, as Karan said, even for an SIP, we try and do an asset allocation depending on the risk profile. Secondly, because these are first time guys. Secondly, we always try and stay on the large diversified equity funds. So idea would be to look at a large AMC in the first place. Secondly, try and see if depending on the age and the risk of the customer, try and give him a balanced advantage fund or a fund which has a good asset allocation of debt and equity. And the third is, try and not become very adventurous and keep it to large, diversified equity funds.
Given that right now there is a credit squeeze, banks are criticized not for lending. How can one be bullish on the economy and on the health of financial markets when we know the wheels are reversing?
Thanks, Nikunj, for putting a question which is probably being asked every minute and every hour in today's economic scenario. But the fact of the matter is that banks, it is not a situation where banks are not lending. It is a situation where there are, I would say that there are situations when the borrowers are not borrowing. They have got the sanctioned limits, but they are not availing those limits. So naturally, when the wheel of economy has come to a grinding halt, naturally, no entrepreneur would like to take the interest cost on their books. So that is a kind of a scenario which we have witnessed. And I would say that this kind of a scenario we have seen of course, now post-COVID, this is a reality. But before that also, I would say that from the second half of the last financial year, we did started seeing some kind of a recovery in the credit offtake, and which got pronounced in the last quarter, which is January-March quarter. But thereafter, suddenly in the last fortnight of March, we had seen this outbreak of COVID, and that actually has led to a situation where the economy has actually come to a grinding halt.
After hearing from mutual fund distributors, next, leading independent financial advisors pitched in with their views on the art of fund house selection and scheme selection.
How do you go about applying the process in a non-emotional but a scientific manner of fund selection?
Okay, so first of all, it is a very simple process of 4 P's. And the 4 P's constitute of people, philosophy, process, and performance. And then the last one, which comes is that, am I comfortable with this fund house? Is he probably telling me and acting and doing the same thing what his RM is talking, his regional head, his national head, and the CEO? I think if it's a one language company, I think that's the ideal fund house to choose for.
So, what has been your learning in this crisis? The reason why we are using the word crisis is because we've never seen something like this before.
We as a financial advisor, our job is to make the right investment advice to the client on 3 most important parameters, that is the risk, return, and the time horizon. So our group internally has made it mandatory to measure the performance of each of our colleagues, which is based on individual client risk and his goals. So in fact, I would like to stress here is that we get a lot of credits depending upon our performance rather than the AUM which we add at the end of the year. Because largely we believe that performance would anyway follow up assets. Secondly, it is mandatory for us to sit with our investor and ensure we explain to them the nuances of the investments in their portfolio.
How do you handle difficult clients? Because right now when you see money going down, every client becomes a difficult client, right, Ashish?
Not exactly. So as we discussed earlier also, so we have divided. So we at Vista do a lot of observation of our clients base, because we have a good team, 15 people are advising clients, and then other people, 35 people team. So there is a set of people, we observe the behavior of the client. On the basis of that, we have divided the client broadly into 4 compartments. So our major time is going right now with the curious investor who have typically come around 2016 and 17. And these are, I would call, challenging customers. Rest others are, looking more for opportunities. And the main concern of the customer is, whether to cash in on the opportunities or to have cash in hand. That is one part. Second part is they want whether they buy panic or they have peace of mind. Third is whether the recovery is coming or whether recession is coming. So these are questions which typically clients are asking. And what we are telling them is focus on your temperament rather than temptations. Focus on long-term earnings rather than short-term emotions. Focus on 3 years rather than 3 months.
What is your understanding of the client behavior? You at Purple Pond have been running this business for nearly 2 decades now.
We have added a lot of STPs during the month of March and April. So as we move on, the client education is helping them. And they are also coming to understanding that if I am able to accumulate more units, this is the time where I will be able to accumulate more units. And if my goal is 5 years away, 10 years away, if I'm accumulating for retirement, this is a temporary phase which I have to pass through. And most of the clients are understanding if their expectations have been kept at the level they should have.
Next week, we'll bring you the highlights from day 2 of the 7th edition of the Aditya Birla Sun Life Mutual Fund presents Voyage 2020, Navigating to a Better Tomorrow, partnered by ET Now. Stay tuned.